Gold and silver hit the brakes hard this week, and short-term traders are now asking whether this is a healthy pause or the start of something deeper. After a strong run higher, both metals reversed sharply over recent sessions, the kind of reversal that rattles positions and forces traders to reassess. Moves like this are sometimes called violent pullbacks in market shorthand, not because they're unusual, but because the speed and force suggest something more than routine profit-taking. When a market drops that fast, it typically means traders are repositioning, not just locking in gains. A few forces tend to drive these sudden moves. First, the US dollar. Gold and silver are priced in dollars globally, so when the dollar strengthens, those metals become more expensive for buyers in other currencies, and demand pressure eases. Second, Federal Reserve expectations. If economic data comes in stronger than forecast, futures traders who had been positioned for a dovish Fed can unwind quickly, and that pressure hits precious metals fast. Silver tends to feel these moves more than gold. It has a larger industrial demand component, meaning its price responds not just to investor sentiment, but to manufacturing and economic activity. When risk appetite shifts, silver often falls faster and harder. It can also snap back more sharply. The gold-to-silver ratio, which tracks how many ounces of silver it takes to buy 1 ounce of gold, is worth monitoring right now. A rising ratio signals silver is underperforming gold, and that can tell you which metal is absorbing more selling pressure. For gold, the technical picture comes into focus after a reversal this size. Traders are watching key support levels, moving averages, and areas where gold previously consolidated before moving higher. The question is whether this pullback is a reset within a broader uptrend or the beginning of a more meaningful correction. The underlying fundamentals haven't changed overnight. Inflation concerns, geopolitical uncertainty, and central bank demand remain part of the story. Central banks around the world have been consistent buyers of gold in recent years, and that demand doesn't vanish because of a single day's price swing. Institutional and retail buyers also tend to step in when prices dip, which can put a floor under how far corrections run. That said, when a market gets crowded, meaning too many traders leaning the same direction, a sell-off can overshoot what the fundamentals alone would justify. The next major data points around Fed policy expectations and the dollar's direction will likely determine whether this pullback stabilizes or extends further. Watch the gold-to-silver ratio and key support levels in gold. Those two data points will tell you more than the headlines will.